2, 1.
Very
Magic
good,
time.
very good. Magic time.
Now they see us.
All right, excellent. I hate when I get muted by my partner here because I might say something I shouldn't say,
drop
or
an F-bomb.
or some other bomb. You never know.
You Boston guys. Put a scally cap on him, he'll start cussing every
Seriously,
second.
this is my favorite one. You probably know that because I wear it all the time.
Yeah, this is my favorite one. And it's oddly in the video, it probably looks like they're the exact same one, but they're not.
No. We need to get some of
This
the
is a
little
Levi's.
pins. That's a Levi's.
Yeah.
Have you seen the pins?
Random.
Have you seen the?
Yeah, where you put them on here.
Yeah.
Actually, Jimmy from Jimmy's Old Town Tavern gave me one. I don't know what the heck I did with it. It's like they put them on golf hats.
Yeah, right. Same idea.
Yeah. Are we going to do a show? Talk about hats.
We could talk about hats. We could talk about bourbon, whatever, whatever it is. It would be a lot more fun
to talk about hats.
Yeah.
But not to the people watching. They want to hear.
They probably want to hear what's going on. It's been a heck of a week.
It has been crazy.
We if you read the newsletter last week, it kind of ended with, if we can get past this week, things should get back to normal, where the market will be driven by earnings and some of the other underlying fundamentals that, we don't really talk about because we talk about price and charts. But
right.
the reality is, once we get past all this political craziness we got going on, the market, at least if nothing else, the market ought to get back to doing things that
we expect
are sort of predictable than what it is now.
Are we going to get past this? I don't know, man.
Oh, dude.
I don't know.
I mean, so at first I thought it was going to be after this. So on Tuesday we had the Georgia runoff.
Yeah.
On Wednesday we had the electoral college count, and we all know what happened on Wednesday.
Absolutely. Had a couple of buddies there at the Capitol. They were Capitol Police.
Yep. It was a rough day. Now we have whatever many 10 days or whatever it is until inauguration. So on January 21st, do things get back to normal?
Yeah. No.
No. Who knows what the new normal is?
There's no way. Yeah. I don't think we have a new normal, but I think the good thing is, and this is, for the folks that follow us, they know that we do technical analysis, not fundamental analysis. Right. I would say that if you're a fundamental person, right, if you're following that group, you got to be like going crazy because the rules are everything's just topsy-turvy. Right. So if you're a fundamental analysis person, you're going crazy. But at technical analysis, we don't really we care what's going on. We know that it doesn't impact it the way people think it does. And we don't care because what we're really doing is looking at the data. Regardless of what the data does,
right.
We're just looking at it.
Right. I mean, those guys look at data too. The earnings and all the other are data. It's just that
price.
What we look at is the reality, which is all the data that comes together at one point, which is how much I'm willing to sell you a share of whatever it is.
Right.
That's where the pinpoint is right there, and everything behind it, right?
Yeah, we're not concerned with the why.
Right.
We're concerned with the
what is
the what.
Yeah.
Yeah. Not how, not why. What? Right. What's happening?
I had this conversation today. I was out working with a guy all day today, and we were talking about Tesla, and Tesla at 300. I think at some point Elon Musk came out. I can't remember. It was a couple months ago. He came out and was laughing like, this is way too high. Like, this is ridiculous. And that was 50% ago. I mean, I don't even think it was 400 when he was talking about it. Now it's 800.
Right.
And it was high at 400.
Right.
And you can make all the arguments, fundamental arguments for why
that happened.
That is, right? But now it's 800.
Yeah.
Is it going to be 1,200? I don't know.
Yeah. Right.
But I will know because when it crosses down through that 10-day moving average line, I'm going to sell it.
Yeah.
Full disclosure, I don't own it, so I'm not going to sell it.
Yeah.
But you know what I mean?
Yeah. But if you did.
If I did.
Yeah, the funny thing is Jerry's telling me stories about people calling him or whatever, getting in touch with him, asking him when to buy and sell Tesla. And he's like, I'm not even in Tesla, and I'm telling these people when. Yeah. And you gave him great advice, right? Because they were like, dude, I don't know. The chart says.
Right.
Because that's all you're going to base it off of.
Right. I don't know anything about Tesla. I mean, I know I like to drive in their cars. I don't.
You know what I'd say?
I don't drive one, but I like to drive in them.
When they come back out with the Roadster, and of course can't afford it.
They need a convertible.
They did. They had it. It's coming. It's the Roadster.
Oh, I didn't know that.
That's the Roadster. So that we're getting way off topic, but I love 2-seater convertibles.
Yeah.
You got a Roadster right now. Yeah. It's not a 2-seater, but anyway, that was where Tesla started. And then it just wasn't a practical vehicle, right? So they made good decisions to get those other ones. Anyway, they come back with the Roadster. I'm all in, except that pre-sale is like 180,000 or something. Yeah. I don't know. But it's supposed to be the fastest production car in the world, and it's electric.
Right.
So what do we got going on with the TSP?
Yeah. I like the rabbit hole we're going down to.
Let's get back on track.
Right. Okay. All right. So let's do weekly update 10 January 2021. Where it's in
now
2021.
We're talking about the TSP.
All right. Wow. 2021. Interesting because I don't know. Wait, go back one sec, because I want to do one more thing. I don't know. I don't even know if you saw it because you're doing a Facebook hiatus.
I'm not even on social media right now.
So do you remember the picture that we did?
I'm in Zen land.
Do you remember the picture we did from January 9th? Because it came up in my Facebook feed today.
Oh, man.
January 9th, 2011.
Yeah. That was...
We were standing in front of the gym. Yeah. We opened the doors the first time. The Sherpa hoodie.
I had that on today.
I didn't see it then. I didn't see yours either. I don't know. Something must be weird about Facebook. Yeah. But I put that picture up.
Oh, sweet.
And I tagged you in it. Yeah.
So if you guys look at this, that's Crossit and Providence. That's the gym we own together that we need to get back into.
The opening, we definitely need to get back in the gym.
Back in the gym.
Yeah. All right. This is we have to do a show, I guess. All right. Weekly update, 10 January 2021.
But we should.
Okay. Peter Lynch, one of the all-time best investors, without a doubt. He managed the Magellan Fund at Fidelity from 1977 to 1990, averaged 29.2% rate of return, consistently more than double the S&P 500 over that time period, making him managing the best performing mutual fund in the world at that time. I think Ray Dalio's fund has exceeded that, but if you look at that, 29.2% rate of return, average annually from 77 to 90.
That's just crazy.
It's crazy. It's insane. So his quote is, "Stock market decline is as routine as a January blizzard in Colorado. Obviously, it happens all the time. If you're prepared, it can't hurt you. A decline is a great opportunity to pick up the bargains left behind by investors who are fleeing the storm in panic. Not unlike what we did this year, 2020, in February, right? Mm-hmm. If you go back to the Smart Reading tab, you see the alert that we put out on February, I think it was 21st, maybe. And it got we were all in the stock funds until that alert came out, and then we went to 50G, 50F. But it saved everybody a 35% drawdown. And what that does is, yes, it saves you, our number one goal, right, is don't lose money. So it saved you from losing a 35% drawdown. Our number two goal is you got to be in the stock funds when the market's moving up to grow your TSP account. So when we bottomed out and then the 10-day crossed the 50-day on the upside, you had all that much more capital in there to make your PIP higher as you're going forward, right?
If you didn't have that capital in there.
If you didn't, you had to just ride it out.
Right.
And then it took you until however far into the year to get back to even. So if you were in the S&P was up like 16 or 17, somewhere around there % this year, itself. But all that gain came at the end of the year because it had to recover from that 35% loss. Mm-hmm. So we didn't have that. And we're talking, we're going to get this performance page up, and when we do, you'll see our chart just keeps on moving, as opposed to what we're going to see here on the S&P 500 chart. It had a 35% drop in the beginning of the year.
So, yeah, we always get a lot of questions about performance, and we're getting ready to start answering those questions. So we've been working on a performance page. We've got a data analyst that's helping us. I'm very biased.
She'll be happy to hear that you called her out on that. Yep.
I know I'm biased, but she's very pretty, and
yes, indeed,
she's my girlfriend. But no, but she's a data analyst for a
living. She's good.
She's doing a great job at helping us kind of put this together because what we've learned, what we've known for a long time is that first of all, we're always about data. It's not real if it's not data, right? And so if you take that approach, what you start to learn is that a lot of performance metrics that you see, they're only part of the story. It's always that case. It's not it's not anybody trying to do anything, subversive or anything. But when you get your PIP, it's just part of the story.
Right.
Like they literally should have a disclaimer right below the PIP that says, this is just part of the story, right? So I know we're going to get into that a little bit more, but as we build our performance page, we won't just put our PIP up there. We're going to put all the data. And it's transparency. And so the initial, charts that we've looked at comparatively, we're very happy with because our charts go nice and steady and slow up. And the ones we're getting ready to look at, they do not.
They don't. Okay. The market this week looks a little bit different than how I usually do it, but that's fine. It was an historic week for the U.S., right? It's gonna be one of the most historic weeks, probably post 9/11. What happened on the Capitol is probably, I would say, the most important thing that's happened since 9/11.
Yeah, pretty close.
How did that? Oh, and obviously the day before that, 2 Democratic seats filled in Georgia. So we got, everybody says that the market likes a split government. Mm. We don't have a split government.
No.
Right?
Yeah.
So the market likes a split government. We don't have that. We get all Democrats. Then the next day, we have, I don't even want to give it a term. We have an event on the Capitol.
Right. And by the way, none of this is political. You guys can understand. Jerry and I are probably the most apolitical people you're going to find.
For a political science major, I'm pretty apolitical.
That is funny. You're our political science major. But no, we're not taking sides either way. No. We try to stay, when it comes to this stuff, this is not what we're,
right.
it doesn't matter.
No. Yeah. We don't have an
we have an opinion.
Oh, yeah.
We're just not going to express it. Yeah. But the point is like, what does that mean for the market?
Yes. And that's the interesting thing, right? So what happened on the market this week? C funds up 1.83%. S funds up 4.5%. I fund up 3.8%. F fund down 0.94%, which is a completely different conversation. If you're, and we're not really going to get into it other than to just say that interest rates are going up, and that's we could do a whole show on if you looked at the weekly AGG, which is the F fund, it was a catastrophic collapse, and I have some good friends that follow this stuff really closely, and you should expect interest rates to go higher this year for sure. And that's it. I don't want to get into that. Okay, so an historic weekend,
not rabbit hole.
It is a huge rabbit hole, and it's not going to affect us because we don't really play in the F fund.
Yeah.
And that's why. Because a lot of people say, why aren't you in the F fund instead of the G fund? Mm-hmm. Because over time,
there's a return.
The F fund, right, is better. It's not worth being, from my perspective, it's not worth being in the F fund because all I'm using the G fund for is a place to park my money until I can get back into the stock funds. Right. The F fund is affected by different things than the stock funds are, and the G fund gives you a statutory impossibility of losing any money.
Exactly.
Nobody has that. You can't lose money in the G fund.
No, I just read an article about that where all of these folks wish they could create a set of funds like the TSP. You can't because you can't make a law, right?
That's right.
Only the government can.
That's right.
And so they did, and so we get to benefit from that. But that's why we park it in G instead of F because F, as we see in right here on the slide. Yeah. You can go down. G fund didn't go down.
No.
0.94%.
No, G fund goes up.
That's it.
Yeah. Okay. Number 2, PIP. We're not going to get into this too much, but if you, I'm going to talk about PIP a little bit on the newsletter that's going to come out this weekend, and we're going to talk about it on this new kind of thing we're doing for subscribers to the site. We're going to do a monthly webinar kind of interactive live webinar, and it's going to be based around performance. So the first one is actually going to be this Sunday, and it's going to be sort of an intro to the whole thing. So we're going to talk a little bit about PIP and some of the other performance metrics that we do.
And so we're saying Sunday. That's because we're recording this before the webinar, which means you'll be watching this after the webinar already happened.
Yeah, which is fine.
It's my job to keep Jerry on the times.
That's I wasn't supposed to talk about that. Yeah, I messed that up. Oh, well.
But the point, I mean, the point is that we're doing it every month, right? Yeah. So every month, members now, we're calling it sort of a member-only coaching call, right? So we can't. Well, Jerry does one-to-one coaching calls, so I can't say we can't, but it's very difficult to do it with, thousands of members. But so what we decided to do is do it in a kind of like a webinar format. And so we're taking questions before the webinar, and then on the webinar, we're going to go through those questions and kind of lump them together, and because what we found is 90% of the questions are the same. Our two situations might be different, but they're not as different as we think they are.
Right.
And so we're able to answer, kind of coaching questions that people give us. And also, at the end of the day, it's an opportunity for us to sit down with members, people that are paying customers, and talk about performance, talk about, our performance, meaning like, the way we're doing it, and, their performance. So if their performance is less or more, well, why is that the case? Right. Because I think what we're, going to talk about a little bit, or we might not talk about as much, the PIP, right? So the PIP, I told you I was going to be that guy and say, I'll go back to the slide where it says, so, our PIP right now is 26.47. Yep. And so you're going to get the folks, right? And we get them all the time. Mm-hmm. Well, Johnny B. Good's PIP is, 38%. Right. So he's, he or she's doing better than you, right? And, well, that's not the full story, right? Now, one of the things we know about the PIP is it is a weighted performance indicator for each person in the TSP. Right. And so you guys can find this on the TSP.gov website. This isn't just us saying this. Like, it is a weighted algorithm based on what you're doing in your TSP.
Right. Your cash flow within your TSP affects your personal PIP. So it's not apples to apples.
It's not. So if your buddy has got 32 and you've got 14 and somebody else has got 29, it's not apples to apples.
I mean, it's not going to be hugely different. Right. If you follow if you say, hey, I followed you guys, every move you did for the year and your PIP is different from mine, it's because the cash flow that you have is different. Right. I took out a loan out of my TSP this year. Right. That's going to affect my PIP.
Right.
My PIP is 26.47.
Right. And that's us being transparent. Like, you don't have to give that out, but you do because you want to tell people how you're doing. Right. Now, what we're going to do with our performance page is tell the rest of the story. Right. Meaning, the PIP will be there, but more than anything, it's about the maximum drawdown.
The risk-adjusted return is
that's it. All those things that say, all right, well, how much money did I not lose? How much money did I lose? Yep. How did that affect my performance? The PIP is valuable, and it's a good thing. The PIP is not something that only TSP.gov does. It is. We'll get into this later, but it is an algorithm that is industry standard. Yep. But it's only one.
Yep.
There's multiple ways that you would basically rate a fund. Or the way that you manage a fund, which is what we're talking about. And so anyway, guys, we're gonna
get into it.
We're working on
Not
it more,
today, but
and I am taking us off target.
All right. So we've pretty much hit 1 and 2. The next thing is going to be the 2020 wrap up. I was thinking about doing sort of a wrap up of the Santa Claus rally, but it feels like it was so long ago it's not even worth doing. So we're just going to look at 2020, and then real quick, we're going to go through the the regular 6-month charts that we do. 6-month daily charts.
We're already 20 minutes in. Real quick is
it's relative, right? It's relatively real quick. Stand by.
This is a commercial break or bourbon break.
Horse Soldier. Just so if anybody's curious, highly recommended. St. Pete. There, if you ever, the movie is. Help me out here, Army guy.
You're getting sidetracked.
I am sidetracked just for a second because we got to do a plug for the bourbon guys. Horse Soldier.
I'm not drinking bourbon. I'm drinking San Pellegrino.
I'm sure you are. The
Yeah, the movie Horse Soldiers. Yeah.
No, it's not called Horse Soldiers.
Oh, it's not called that, but
What's
yeah.
the movie called?
100
12 Strong. 12 Strong.
Something like that.
Something like that. Yeah. If you haven't seen 12 Strong,
Awesome.
I highly recommend it. And if you ever get down to St. Pete Beach, check out their distillery.
Yeah.
Okay.
Good bourbon.
Very good bourbon. Horse Soldier.
A little pricey though, but they should send us a bottle.
They should. They should sponsor us. Okay. So for the year, the S&P 500 C Fund, right? So what I did here is do vertical lines at the highs and lows, and obviously the dotted vertical lines that are in red is when you would want to sell, and the dotted vertical lines in green is where you would want to buy, because that's where the price is either at a high or a low. So what we have is back when my pen, I'll see if I can make this work. Our alert came out right there. A couple days later, the market tanked. The important part about this isn't so much when we did our alert. The important thing here to see is when the price breaks down below the 10-day moving average, it doesn't mean it's going to collapse. It just means it's much more likely to collapse than when it's above the 10-day moving average. So in that particular case there at the end of February, when it collapsed, it ultimately bottomed at a 35% loss. But that wasn't the case on the previous breakdown through the 10-day moving average, right? On the previous one, right here, right? It broke down through the 10-day, found support at the 50-day, right there, and then went higher. So it's not that we're saying that every time it breaks through the 10-day, we're going to have a market collapse. That's not what happens. But it's the first indicator that you can have a market collapse.
Yep. And that's when you start really watching.
Yeah. And in this case, right?
You started watching that first time.
Definitely. But the difference between the 10-day and the 50-day, I wish there was a better way to do this, but let me just zoom in for a second. The difference between in this section that we're looking at here, the difference between the 10-day and the 50-day is maybe like 1 or 2%. It's not very much. So if the market on the end of January there, when it broke down below the 10-day, I probably wouldn't have gotten out there because the 50-day was so close that you could expect support at the 50-day.
You get some
right?
room.
You get some, yeah. Actually, that's why we didn't get out there. So we were still in the stock funds until the 21st of February when it broke through on that day, and we got out because the difference there was enough that I wasn't willing to take that loss, and then it broke through the 50-day, and then it was just all downhill from there. Okay, I'm not gonna get into any more detail than that. We're gonna talk about that on the webinar. Okay. So you got the red line is where you would sell it. And the other important thing about that is the RSI turned negative, the MACD turned negative, slow stochastic turned over. These indicators don't all work together on the same day. Some of them lead and some of them lag, which is a good thing. You got the RSI had a top here, which was pretty well before. So you had that top, but the price continued higher for a little bit, right? The MACD was sideways and then dropped on this day up here. And same thing with the slow stochastic. So you had an idea that based on the RSI, things weren't looking too good. So that's sort of when you need to be on alert and paying attention. That's what I do. Pay attention. So broke through the 10-day moving average here, broke through the 50-day here, ultimately comes down. Great. The next line was the bottom, right? When the slow stochastic turned positive, the MACD lines crossed, the RSI had already crossed. It was a leading indicator. Okay. And then at an absolute minimum, you get the price coming back above the 50-day moving average. So it wasn't that hard to get back in relatively close to the bottom. To get back in at the exact bottom, isn't something that I would do. But it was doable based on these indicators. So then as we continued forward in the year, you got this high right here, right? It corresponds to this high in the RSI. So anytime the RSI is over 80, you need to be paying attention, right? You see how right there, it just pokes a little bit above 80. You got to be paying attention to that. It doesn't mean it can't stay there for a long time, but once it gets there, when it rolls over, you got to be, if the other indicators line up, you got to get out. So when the MACD rolled over, and the RSI rolled over, and the slow stochastic rolled over, that was definitely a time to get out. But what happened? The price didn't move that much, right? We didn't have this whole thing happen again. We just had a little price move, but we had the indicators, particularly the slow stochastic moved a lot. So you don't always get huge price moves, and that's actually a good thing, because once the MACD turned positive again at this low, you're back in business. All right. You get this high. We had been in the green there, above 80 on the RSI for a while. We had gone sideways for a long time in the MACD, and then the MACD turned negative, right? And the slow stochastic turned negative. You're definitely getting out there, right? But the market, it came down in a 1, 2, 3, right? And we know ABC is a correction. So it didn't collapse. It did an ABC correction. And then went higher. Great. It had bottomed out and turned positive. So we get back in. When I say we get back in, I'm not saying what I did. I'm saying I'm just looking at this chart and sort of doing the analysis of this year and how you could have done it.
Yeah, because the part, this is a good time for a break.
I need a break.
Yeah, is to say that as we're going through this, you have to put your TSP rules hat on, right?
That's right.
If we were day traders, we'd be in and out, in and out, in and out, in and out, in and out.
Yep.
We can't. They don't let us. And we got to make the move before noon. Yep. So I just want to take a second as we're rolling through this. This is a great chart. Like, I love this, even as a non-chart guy. Like, I love looking at this, right? But we have to keep it in perspective. Well, why didn't we do this? Why didn't we do that? Okay, we got 2 moves a month.
Yeah.
Where were we when it happened?
Yep.
How many did we have? Where was it in the month? Because it was early in the month. All of these things are the things that we're going through along with the indicators to make a decision.
To be honest, that is the hardest part for me.
Of course it is.
This chart is easy.
Yeah, if we didn't have those restrictions.
Oh my God, it's easy.
Yeah. So I just like to take a second to kind of put that disclaimer on there, because again, for those of you who've been watching us a while, you're like, oh guys, why are you talking about this again? But we're constantly having new people jump on board,
yep.
And we have to remind them, because 9 times out of 10, when we get a new person on board, it's because they have not been managing their TSP.
Right.
They do not know much about analyzing the market. So we have to stay at this kind of level of education, particularly on this kind of public show, as opposed to what we might write on the member site and get into the details. But if we have somebody that jumps on board and say, hey, I don't even know what you guys are talking about. Well, the takeaway is be in the G fund when the market's going down.
Yep.
Be in the stock funds
when the market's going
up. And number one, don't lose money.
Right.
And so as Jerry's going through these things, we may not have been, or we might have been in for different factors, meaning it might have been at a time where we've already had 2 moves.
Right. That's right. That honestly, those TSP rules are the last part of the process of how I come to a decision about making a reallocation. So when we put out alerts, and I don't want to really get too much into this, but we've talked about how, and there's a post in the Smart Reads about the mechanics of that's what it's called, right? The mechanics of an alert.
Yeah.
The market opens at 9:30. You have to have your trade in by noon to get that day's closing price. You have to not assume, but you don't know what's going to happen for the second half of the day. That's bad enough. It's the last thing. So once all the, if you're looking at this chart, I look at the chart and I look to see if I want to sell or buy, and then I have to look at where we are in the month. How many moves have we already used? If I make the move, what's my next move? Mm-hmm. How many days can the market go one way or the other before I can reasonably make the next move? I mean, you can definitely mess this up if you're, from my perspective, for me,
right?
Right? I feel like I can really,
because by and large we're low risk.
Yes,
by and large.
Yeah. And you can always get out, right? So
that's the key.
The nice thing about TSP is they sort of give you an out. The worst case scenario is I use my 2 moves in the first week of the month, and then the market goes against me, and I say, forget it, I'm out, right? And I go to all G. The only loss, quote unquote loss, I take is the loss of a gain that I could have made. So I'm not losing any money by going to the G. I'm just not. I don't have access to make any more gains.
Right. And that's a low risk position.
Yeah.
That's the whole point. If you follow us, you're going to see that we take the low risk position. Now, I will throw a quick little caveat in there, is that we are looking to add moderate to high risk as for those that want to fall into that category.
Yep.
It's something we're still working on, but we're going to make sure that we have the process right.
We get a few things in beta.
A lot in beta.
Yeah.
When this guy retires, we're going to be going 1,000 miles an hour, and we only got about 90 days.
Yeah, we don't have long.
All right, back to the slideshow. Enough of a break.
So I think that pretty much covers it. You guys get the idea. But let me just throw out one thing, because we're going to get to it on the 6-month chart. Sort of. 1, 2, 3, 4, 5. Hopefully you can see that.
Kind of.
1, 2.
Yeah, it's hard to see. But
3.
It is, yeah.
A, B, C is 4. 5. Okay. Let's see if I can do it.
It's Elliott wave.
Yeah.
There we go. Now we can see a little better.
That's 5 steps up on the Elliott wave, right? So that gives you a 1. Okay.
Because we're starting back over.
Because now we're going to start back over. So that gives you a 1 right there. Okay. Then you got A, B, C. It's going to give you a 2. Okay. And ultimately you're going to get to 5. Mm-hmm. So this area in here is the beginning of the 3.
Yeah.
So in the big scheme of things, if you're in here somewhere, the default is going to be in the stock funds. Because unless you're completely wrong on your Elliott wave count, which this one is pretty clear, I'm not too concerned about the market, about a couple percent here and there, because I know in the big scheme of things, the market's going higher from here. Right? I got to remember when I need to stop talking about the paid side versus the free side. All right.
No, we're giving out good info.
This is yeah, it's good stuff. All right, that's it for the C fund. S fund, for the year, I'm not going to go through it, but you guys get the idea. It's the same kind of thing. We came to a top here. It just happened to have this catastrophic drop here. And the cool thing about the S fund here is that the 10-day and the 50-day were really close together, right? And as you can see, when it dropped down that day, it gapped down below both the 10-day and the 50-day. I mean, if you remember, there were people definitely that said right here, you should buy because the market always goes up, and we're collapse. It's below the 10-day and the 50-day. Like, it's a great time to get back in. Well, I mean, not from my perspective.
Maybe,
right? Now, obviously, we didn't know about this at the time, but I would not be buying a gap down through the 10-day and the 50-day.
Yeah, we're gonna wait for the 200-day.
I mean, yeah. Now, again, that's one of the things that we're going to look at is at a high risk and a low risk position as we go forward. But I don't have the 200-day on this chart, but when we got down here, right, we were at the bottom. Once it turned positive, once we got above that 20 line on the slow stochastic, and we crossed on the MACD, and the RSI turned positive, I mean, you have to get back in. There's risk, but you know that if the market turns against you and rolls over and gets below, so this is 900, if it had gotten below 900, you just get back out, no big deal. But it didn't. The risk reward was huge here, right? And obviously it was that. S fund had same thing. 1, 2, 3, 4, 5. 1. Right? Then I'm honestly, this is ABC, right, for 2, and now we're in this crazy thing with the S. I mean, it's S fund is crushing it, particularly from here. So the S fund hugely outperformed the C fund since the end of October. We had right here, we got the S fund breaking down below its 10-day moving average. And there was some, reasonable concern there, but it didn't last long, and then ultimately moved higher. So yeah, it's the same idea. You guys can see you got a breakdown there. You got the RSI turn negative. You get the MACD lines crossing and the histogram turn negative, and you get the slow stochastic turn negative. So you can execute those as you will, which is why I wasn't in the S fund during that time. Okay. I fund, same kind of idea. 1, 2, 3, 4, 5. 1. I mean, and then you get this long horizontal consolidation pattern. Okay. So right here, when we gapped up on the I fund, slow stochastic went positive, MACD went positive, RSI had been at the lowest it had been since back here, right? And then went positive. And we've done this before in other shows, but that's basically the channel. Once it got above that channel, it goes higher. I mean, I don't know how else to describe it. The stuff works. The stuff works.
Bottom line, man.
You got to be able to see it, right? A lot of people look at this chart and they go, "I don't see what you see."
Yeah.
And I get that.
I get it.
And that's why we're doing this. Yeah.
Yeah, I get it. But the takeaway is the more you look at it,
Yeah, you'll start to see it.
Yeah, and I remember the day that the S fund dropped below the 10-day moving average, and I was like, oh, and I'm looking at it and I'm thinking to myself, okay, well, let's look at a few other indicators. Like, as you start to do this more and more, which Jerry's been doing it decades longer than me, but I feel comfortable looking at the charts. If I look at a 6-month and a 3-month chart, I feel pretty comfortable managing my own TSP outside of. But what's nice is having a technical analyst to validate my decision.
Yep.
And that's kind of as if you aren't as aware, if you're kind of new to watching this or coming, that's what we do here. We're not telling you what to do with your money.
No.
What we're doing is providing you all the information we can to validate your decision. And hopefully you learn just enough, right? You're not going to become a technical analyst. None of us. I don't plan on it. Yeah. But what you need to, and you could use us and you could use someone else. You could use 2 or 3 different, analysts who do this to say, okay, I feel comfortable. Because here's at the end of the day, it's about what your personal risk tolerance is.
Right.
We've talked about it time and time again. It's like, okay, well, I want to jump in before I quite know. I want to just roll the dice.
Sure.
Right?
Sure.
That's pulling the arm, not rolling the dice. I want to roll the dice. I want to roll the dice. And that's great. And you might get lucky and you might not. Yeah. And that's why you're going to see, like, when we show our performance stuff, right?
Yeah.
We might not have some astronomical, numbers, crazy
right.
But
we are the most conservative.
Peter Lynch did 29%.
And he's the best ever.
Right. So when you hear people say that they're getting 30 and 40% and all, it's not that they're not.
Oh, they are.
It's just there's more to the story.
Yes.
Right? And are they consistently doing that over time?
Yeah, no.
Yeah, I would argue that they're not. If they are, they need to start a freaking podcast that we can listen to.
Right. And to be fair, so to be fair though, one of the big reasons why this year there was even the possibility to get 40% pips
was that huge.
Was that drop?
Yeah.
Most years, because we're only doing the S&P 500, which is a relatively not volatile index, right? We're not trading oil futures contracts, right? We can't create stuff, right? So the best we can do is to be in the stock funds when the market's going up, and we take whatever the market gives us that year.
Yeah,
we can't do anything other than the 3 TSP stock funds, the 1 bond fund, and the money market. That's it.
Yeah.
So you can't. There are years that you cannot mathematically get more than, say, 10% or whatever,
because the market didn't.
I mean, if the market was down for the whole year, let's say, right? Well, I mean, if the market overall is down for the year, it's still probably, so if the zero line is here, it probably goes up and down, but it's below the zero line, and then it comes back up to zero, so it's 0 for the year. We would probably be positive that year, which actually happened in 2018, right? Because the market was down 5%, we were up 5%, so our delta was 10% for us, which is good.
Yeah. But most people would look at that and say, "Oh, you were only 10% in 2018." Yeah, but the market was negative.
Right.
Like people lost a lot of money. And we didn't.
Right.
We just didn't. It's not bragging, it's facts.
Yeah. Yeah. Okay.
All right.
That was I for the year. Okay. Last thing real quick, the 3
6-month charts.
6-month charts. So now we're back to current day. So the idea of the last 3 charts was to do a recap of 2020 and when the highs and lows were and what you could have done based on the indicators and all that. Now we're back to the regular daily stuff. So let me just start with this because I feel like doing it. This right here, this is a correction that's significant, right? It's an ABC correction. And so you're going to get a move higher out of that. This is it's not long term in terms of years, but it's several months of correction. After several months of correction, you get a move, whether it's one way or the other, but you're going to get that move. We're in the middle of that now. So that's kind of why, for example, this day, right, I didn't get out. I think the day that I called you and we're like, we need to do an alert, right?
Yeah.
So we were 50%, I think, when we did the alert, maybe we were 50C, 20I, and we went into all stocks,
Yep.
right? So the reason we did it is because on that day right there, on that day, all of the stock funds by, I don't know, 10:30, 11 in the morning were above their 10-day moving average. And you can see it better on the next chart on the S fund, but based on that correction, and we had only moved this far, I was going to give the benefit of the doubt to the market going higher. And it turned out to be, correct, basically, because the market is going higher. So again, it's art and science. I mean, there's data, and there's the moving averages and trend lines and all that, and then there's like the feel of it.
Yeah, but I mean, let's not take away from the fact that the reason why you made that decision to stay in is because the indicators were telling you this isn't the end.
Yeah,
we just did a correction,
right?
So it's not you going, oh, I hope we go up.
No, absolutely true.
It's not that. It's no, everything's telling me to stay in.
Yeah.
Because one of the things that I kind of pride, what is one of the things that I'm proud about is that your ability to take emotion out of it.
Yes.
Because it's not that you don't have emotion about it, because I hear it.
Right.
I get the emotional phone calls or texts.
Right.
But you're like, look, man, this is what the facts say. I have to go with what the facts say, which was we had a consolidation. This is pretty early.
Right.
Why would we get out?
Because we crossed down the 10-day moving average. So your facts are conflicting.
But that's just one indicator.
It is. And they're both one indicator.
Yeah.
And so at some point you have to resolve that difference, right? So
that's experience, though.
That's experience. And that's what I mean. That's why.
But art makes it sound like guesswork, I think.
Oh, I see what you're saying. Yeah. No, it's not guesswork. Yeah. I see where you're going. It's
lots of years of doing that to go, no, this is like time is on, like history's on our side with this decision.
Right.
Yeah, let's stay in.
Yeah. Yeah. It's because we preached the 10-day moving average.
Yeah.
And so
that's
I got
just one indicator.
Yeah. I mean, I got a lot of comments and things on Facebook and Twitter and stuff about we're below the 10-day moving average. Why aren't we getting out?
Yeah.
Well, there's more to the story. Right. I mean, you go back a couple of months and we had a good consolidation, and we haven't moved that much beyond it. So, I'm going to give it a little bit of room.
Well, so that's what I was going to say is there's many times, though, that we have to let it play out.
Yeah.
It hasn't told us enough. Just because, and again, it goes back to the rules, right? So we've got to make all these decisions before noon.
Yeah.
That's not enough sometimes. You got to let it play out. Now, the next day you get enough and you go, okay, well, it's time. And that's why sometimes people will kind of, fault it for being like, oh, you could have got out sooner.
Yeah.
It'd have been guesswork.
Yeah.
It would have been guesswork. We
right.
don't work on guesses.
Yeah. Right. Yeah.
All right.
Yeah.
Next slide.
Guess, you saw me going, my little brain was going down a rabbit hole we probably shouldn't go down. Yeah. Okay, S fund. Here was the interesting thing about the S fund. It was crushing it since the end of October, right? Get this huge move higher on the S fund, absolutely outperforming the C and the I. And then we had a couple of rough days, and then we broke the 10-day moving average. So we went it was a quick one. Why was it doing that? It went A, B, C. It did a little ABC within that circle that's kind of hard to see. But you get a little ABC in there. And then after that little ABC, on the day that it closed above the 10-day moving average, that was the day we got all back into stocks. Because we had this huge move, right? And then we had a consolidation. Once it got back above that 10-day moving average, the odds are it keeps going. So you also got MACD crossing, histogram turning positive, RSI is already positive. Everything indicates S-Fund goes higher from here.
Bada bing, bada bing, bada boop.
Yeah. It's not that it's obvious and simple and stuff, but it's kind of obvious and simple. As soon as you got outside that downward channel, you got to get back in. And that's what we did. So that's the S-Fund. I-Fund, I mean, you get some pretty big volume. You got RSI positive. You got MACD crossing positive, and you got histogram turning positive. And you get support at the 10-day moving average. It's kind of a no-brainer. And it's a little bit, we're talking about it in hindsight a little bit because it's already happened. But we were looking at it, we're looking at it all the way along, but we're looking at it right there. When these things, even after that one day of big volume down day, right? But that big volume down day only gave us support at the 10-day moving average. So again, I like what you're saying. It's experience more than art, but whatever you want to call it, the more you look at the charts, the better you are. The more you ride a bike, the better you are. Okay.
Questions. I was waiting for you to turn it. All right. Well, hopefully we get some good questions on the show. A lot of folks. So we put this video up on Facebook, and then later on it comes out on YouTube. So both places you can go, you can find it, and you can put comments in both places, right? A lot of times it takes us a little while to see the ones in the YouTube, in YouTube, not the YouTube. Sounds like my grandma talking about YouTube. You got to go to the YouTube.
Do you have a Facebook? Do you own a Facebook?
Yeah. So anyway, we do read the comments. We read all the comments. We tend to end up seeing the comments on Facebook a little faster. If you're not in our Facebook group, feel free to join. We have a lot of discussion in there, and I think there was a lot of good info in there.
Yeah.
Did you have a good time doing it, Jerry?
This show?
Yeah.
This is a good show.
Yeah.
I think we got a lot of good stuff down here.
Yeah. What's crazy is like every week I think to myself like, it's going to be the same old charts. And it never is.
No.
And I'm not even a chart guy.
I mean, this week, the thing that amazes me about this week, honestly, is I did not, and I think you would have gotten the hint from last week's newsletter. I thought that if there was a sweep, right, that the market would have gone lower. I definitely thought the market would have gone lower about that. I didn't know what to expect for Wednesday, but I expected there to be a lot of volatility, right? And the volatility ended up not manifesting in the market, just in society,
in the media,
right? In reality, I mean, it's social. It's huge, right? This is going to go down in the history books as a big deal,
right?
But the market went higher from both of those things.
Yeah.
And so when I called you on Tuesday, I think it was Wednesday.
Yeah,
Wednesday morning. So this is Wednesday morning before the stuff at the Capitol, right? But it was after Tuesday's Georgia election, but I think at that point only one seat had been confirmed.
Right.
The second seat had not.
Still hadn't been.
Right. But I'm like, dude, got to get back in. The S-Fund had popped back. It did the ABC popped back up above the 10-day. I'm like, that's it. We're back in 100%. I mean, everybody's like, market can't go higher. It's been crazy going higher. I'm like, you're right. It can't go higher, but it is.
And it does.
And if it is, I want to be on it.
Exactly.
I want to be on the train.
Be in.
That's it. I don't know how. And honestly, it's I think we've talked about it before. I have been consistently really good at getting out at the top, and I have not been as good at getting back in at the bottom.
But that's a low risk position.
It is a low risk position, but I'm working. It's like a personal thing that I'm working on.
You're working
right?
through it. Do you need counseling for this, Jerry?
I'm counseling myself. Because I'm a low risk come from. My personality in general is low risk, which is not unlike every government employee.
Right.
Your come from is low risk, right? But I'm forcing myself to get past the feeling of not wanting to get back in and looking just at the chart, just at the data, and going, all right, I'm getting back in. And then I know that if I'm wrong, if it rolls over and it crosses that line, then I'm out.
Right.
Right. I have it's not like I'm just throwing myself into it. I'm working against my
intuition
feelings sort of.
Yeah.
But I have a safety net because I know my line.
Yeah, but you know what's interesting, and I know we're kind of dragging out the end of the show, but hopefully, if anybody's still watching,
if you're still watching,
yeah, we're done with the charts.
We'll
I'm turning it off.
Yeah.
But as we know, after 30-ish years, whatever, in the government, there are so many government employees and probably many more military members, right, that don't even know where to start, right, in this conversation. So when you say you're low risk, they're like, it's not even a risk factor. It's like, I don't even know what to do, right? So the fact that, you're not jumping in when it's the perfect time and you're not jumping out when it's the perfect time. And if our mission with this project, with this business, is to teach as many people as we can that you can figure out some of this stuff. You can look at the charts. You can look at them and say, I should be in. I should probably be out. That's it. That's all. Like, we're not wanting everybody to be like,
You don't have to finance from,
Don't be. We're not trying to make you Peter Lynch.
No.
Or Warren Buffett.
Nope.
God forbid that.
God forbid is right. I wouldn't want to. I'm not sure I would want to have a bear with those guys.
But God forbid you're a private in the I was going to say a private in the Navy. That wouldn't work out.
All right, there, Army guy. Jesus.
But
it's been a long time since you've done drill. You need to go back on drill.
I know, right? Yeah. No, I don't. If you're E1 or E2 or an O1 or O2 or you're a GS9 or 5 or whatever, you're just starting out. You're getting into this thing and you're like, I don't even know what these guys are talking about. Trust us. Just a little bit of information and you can seriously just, with very low risk, manage your TSP and you will be a millionaire, if not a multimillionaire, by the time you leave the government. If you stay in for an entire career, and if you leave the government early, fine, do this same thing with your 401k.
Yeah.
Like, it's the same principle. It doesn't have to be the TSP. We focus on the TSP, but we have lots of people that follow our stuff that do it in their 401k. Because the 401k funds, every fund they have matches up somewhere with a TSP fund. Like it's still the Dow.
It's the S&P 500, the Dow, the NASDAQ, whatever.
It's all the same thing. Yep. So these principles work. So don't beat yourself up, Jerry, for not always calling the bottom. We really like it when you call the top.
That's the number one rule.
Right? I love it when you call the top. Yeah. All right. That's a good way to end the show.
Yep.
We appreciate you guys watching. If you're still watching, share with your friends, comment on Facebook or YouTube, and we really hope you're going to have a great 2021.
Yes.
Because we plan on having a great 2021 because we'll both be retired.
It's going to be a good year.
I can't wait till Jerry's retired.
You and me both, brother.
We'll drink a lot more bourbon then.
And ride motorcycles.
And ride a lot more motorcycles. All right, we're out.
Peace.